Hey traders, Stephen Quitzel here with TradersPlan.com. It's Thursday, March 14th in the morning. I've been gone for the last week at a trading conference and I got a really good idea for a training session for a webinar for you guys. So we're going to cover the market today. We're going to go over the market. It's really looking strong. And then we're going to cover, some exit strategies. It's amazing. I'm going to show you 5 exit strategies that you can utilize for yourself as far as trade plans go. And it's amazing, when you look at 20 trades, you look at your past 20 trades and you say, okay, what if I would use this exit strategy, and then you come up with 3 or 4 ideas, how different it can change your performance. So I'm going to show you my first 20 trades of the year. I did okay, and then I'm going to show you what I would have done, if I would have used different exit algorithms. And, it is really mind-boggling to me how different they can be. But I think this is some of the best information I can give you, and I hope that you can take this and put it on your own trade so you can find out, okay, maybe I can take some of these strategies and, take the last 9.5 months of the year and really improve my performance. So I promise you're not going to want to miss it. Just kind of hang around. So let's really start with the Nasdaq. I really want to jump right into this because it's very interesting, and this reminds me of really a super rally. So let's think about this for a second. Let's focus on the Nasdaq. This rally has gone on way longer than I thought it would, and it cost me money. Right? I thought it was going to break down right here. Thought it was going to break right down right here. Thought it was going to break down right here. And here we are. So it's just really interesting. And now we're kind of at this pivot point. But, it makes me think that we could be, and I've seen this before, when the market started to sell off and then it broke, the 20-day EMA, the rally line. I was like, okay, now we're just going to get a correction. I don't think it's going to come all the way down to here. And the reason I still don't think it's going to come all the way down here, of course it could, the market has a way of humbling us, is just the way breadth and growth stocks have been acting. They've just been acting so well, they would just really all of a sudden have to change character very, very quickly to come all the way down here. It's not to say it couldn't happen, but it's just, I'm trying to, based on as strong as this is, it completely overshot. I think it pays to be a bull. And that's just one thing that's cost me over the years, and I'm trying to get better. Sometimes I just think the market should go down, it doesn't, and it overshoots, right? So, hoping you can learn from me, and I think you're going to find some things where you can definitely learn from me and do better. So, when this happened, you had that Friday reversal bar. Obviously I started to pay attention. And then on Monday, when the Nasdaq was up 2%, that really caught me off guard a little bit. And I'm like, okay, I just immediately thought of 2017 and 2013. And what I mean by that is I want to kind of go over. So a lot of times when the market is rallying really strongly, it'll stay above the 20-day moving average. Well, there have been in the last 5-6 years some rallies that just break the 20-day EMA one time, for a couple days, find support and just come right back. And that's why, because you can see that it broke the 20-day moving average 3-4 times right here, and it still went parabolic. So when that happens, when you get that first sign where you're in a rally and then it just breaks, but it finds support at the 50 and then comes right back, you could be in a major rally where the 20 isn't the line, it's 50. So, because you can see right here how many times it happened. So when it happened on Friday and then it just bounced back, I'm thinking that this kind of move is very much a possibility. Doesn't mean it can't consolidate, but if the market really just shoots out of here, really the point I'm trying to make is if you look at history, when you have just a strong rally and then it comes out, shakes everybody out of the market. And don't get me wrong, this ran 2 or 3 of my stops and just stopped me out. A couple stocks it didn't, it kept me in and just shakes everybody out and then heads higher. Well, that's just a sign that just the market wants to continue higher. So I don't think we'll know for a few days or maybe even a week, but if this continues to rise, I would look for that break like it is, as more of a buying opportunity instead of a threat that the market is going to absolutely roll over. So, right now, I think you got to play the buy side, the long side, and just, and keep an eye on this line right here. You also have this curling 50-day moving average that's getting closer and closer. It's just kind of it would really amaze me if we just completely got out of here V-shaped style, because that hasn't happened until really the late 90s. Like, you're always having these double legs down, and that's one reason why I look at this and I'm like, okay, history tells us that we're going to take a second leg down. So I was looking at a lot of this zone in here. I was like, okay, eventually this is going to crack, shake everybody out. Didn't happen. Still could happen. But, I think just right now we really need to kind of pay attention, because if the market does roll over here, there's going to be kind of two places of support, the 50-day moving average and, this reversal zone right here, which there's a lot of price volume in here. So, if I look at this, I think it's very important just to kind of see what happened here, and then look over here, and we're going to look at 2013 in a second, say, okay, if the market, just is still looking good in a few days, I need to be incredibly aware that we could just be in this super rally, and we could easily come all the way up here. So, you can raise your stops along the way. Maybe a lot of you kind of got stopped out up here. I had some positions that got stopped out down here, and that's just part of it. That's what the market's trying to do, is trying to run the stops, to get everybody out, and then just frustrate the bejesus out of you. So sometimes that's why I do like the 50-day moving average, because if you see right here, it just gives you a little more room, a little more breathing room for the stocks when you get these mega rallies. So now a lot of times, if there's a stock that goes straight up, I might use a shorter moving average just because it's going to be so far to fall down, and it might or might not find support. But let's look real quick at 2013, because I just kind of want you to remember this, and how it's doing that. And then we have, the first potential shakeout. And it could only be 2 or 3, but let me go over here to the Nasdaq and just kind of show you what I'm talking about. I'm going to drag this over right here. Let me just kind of go to 2014. It's not as pretty, but look at this. You have a lot more kind of volatility on this one versus, if I pull this was a lot cleaner, right? And then we go back to 2013, and 2013 kind of went up. So if you would have held your positions, you'd done very well. But look at this, you have just major rallies, small little pullback, major rally, small little pullback. This one broke, but just for a day, and then came right back. So look at all these bounces, and then it comes back again. So I'm not making a prediction here, because I think making a prediction, for the market to come down is what got me in trouble a little bit. But I'm trying to put history in front of you to make you aware of what has happened when the market is strong, and then it'll quickly shake you out of the 20 and find support at the 50 and then pop right back. How long this sucker could potentially go. And, even though we've had a bear market, I still think we're in a major bull market where, you could get, 10 to 20 years of double-digit average returns. So you really want to pay attention and make sure you're not missing out when this happens. I think that's very important. So, and I'm going to show you why here in a minute, holding on to positions or giving them a little bit more breathing room is going to pay off in the long run. There's going to be some short-term hiccups with that strategy, but I'm going to show you. So let's look at breadth real quick. I'm going to look at the breadth, and then I'm going to look at the sectors, and then we're going to look at some different exit algorithms, and I'm going to show you why exits are more important than entries. So let's look at this. This is the breadth for the 20-day moving average, the percent of stocks above their 20-day moving average in the S&P 500, and you had this right here. So it was really interesting. We had right at 2 months where most of the stocks, 70%, were above the 20-day moving average. That is a really, really long rally. Let me be crystal clear about that. That's a really, really long rally. It's almost an outlier, one that you might get every 4 to 5 years. So it's reasonable to assume that they don't always last that long, okay? And then you had the dip, and I'm like, okay, this break of the 70% range started to happen before a couple days before the market broke the 20-day EMA. So, okay, so now I'm like, okay, that makes sense. Breath starts to crack before price action, and the price action, continues to fall. It came right back. So, is this going to continue? I don't know. I think you just need to be open for either way to happen. And kind of the way I see it, if we go back to the price action right here, try to give stocks maybe just a little bit of breathing room to see if this pivot will hold and this 50-day moving average could hold. Because it could just bounce around and consolidate right here, could head up, or it could roll over. But I'm going to show you how important trading mechanical is here in a second, just based on how I'm kicking myself for not changing, my exit algorithm. But that's okay. You live and you learn. So let's look at the breath on the kind of longer term. Let's go. All right. So again, this is the percent of stocks above the 200 moving average. You had really, really bullish. It's still bullish. Then it drops below 60%, which is more corrective type action. But it came right back. So is it going to chop around? Is it going to roll over? Is it going to continue? I don't know. Let's just try to make it mechanical as possible. If you have a stock, you hit target number 1, then take half off, and then try to let the rest run. And I'm going to prove that here in a second. Let's look at the sector summary. I really think the most important part of this presentation is really what I just showed you, but then I'm going to show you some exit algorithm strategies. So again, just have an open mind. Whatever happens, it's okay. If the market takes another leg down, that's okay, because one thing that I have always learned, that let it run your stops, it's fine. And then, because typically strong rallies come out of strong bear markets or strong corrections. I'm going to just bring this back over here for just a second and look at, the double dip. These weren't quite 20% dips. These were around 15, but, look at what happened. Like this really, this, you had kind of a double bottom within a double bottom, but this really sucked everybody back in. And I remember even like right here when the market was pulling back, stocks were looking good. They were looking really good because I was buying right here because I was just looking at growth stocks, and it just never materialized. So I had to let it go, had to let them go. But then, coming out of that second leg right here, you had a couple blips along the way, but then you just get a major, major run. So make it mechanical. We look at the sector summary. We're just kind of looking at the last week. Real estate has been strong. Technology has been strong. Utilities have been strong. It's always weird. I'm okay with utilities being up there because I've noticed that if utilities are way leading the pack, then I have a concern. I'll find a lot of times, at least in the last couple of years, technology and utilities, even though one's defensive and one's aggressive, I mean, they can be up at the top third, right? I'm always kind of looking at the top third. So technology is still up there. Let's look at the last 1 month. Utilities are strong, and I think a lot of that also has to do with what Treasury yields have been doing. They haven't been doing so well. We can look at that too, but technology is still up there. So again, in the last 1 month, even we can look at the last 3 months. Since the rally, this hasn't been a full 3 months, but you can see that materials, technology, industrials, I would still say it's a pretty good bag. Now, we'll kind of watch this. I think we'll watch the REITs and the utilities, but focus on the price action. You can use these secondary indicators. As far as I see sector rotation, I might put a little bit more weight in the market breadth first before I see the sector rotation, but I'm almost looking at them both. But again, if my stocks are still holding up, my trades are still holding up, I'm going to let them run a little bit or try to. So just kind of keep that in mind. Let's start with these exit algorithms. So let me kind of give a little bit of a backdrop here for a second. I want to kind of drag this over, okay? So we're going to look at, my first 20 trades of the year. We're going to look at samples. I'm going to look at what I actually did. And then I'm going to show you an additional 4 exit algorithms, exact same entries, giving you ideas for different mechanical strategies just to show you how much better a mechanical strategy did than an exit out, just kind of more of a discretionary strategy. So I'm going to show you these, and honestly, I think this is one of the most eye-opening. I went to a trend following conference, and I'm a trend follower, but sometimes I still use discretion, especially when it comes around earnings. This was probably the most eye-opening thing that I've ever done. Just looking at myself and really saying, okay, I think I've been pretty good this year, but how can I get better? I tend to be trend following in nature. Sometimes I might sell something before earnings or something like that, but I just want to show you the difference, and hopefully you can look at this and say, dang, you can take your last 20 trades and use these exit algorithms, and it can show you how important exits are versus entries, how you can have a completely different system, okay? So let's start. I want to start with, so I have really, and I'm kind of going to do these one by one. So I have entry system 1, 2, 3, 4, 5. Okay. I want you to really, really pay attention because this is very, very important. And I think it's just one of the best things I've ever done. I hope you get as much out of it as I did. So entry number 1 is more of my discretionary. This is what I actually did. Now, to be fair to myself, so I've averaged, historically, I'm about 3.5% per trade. And that's not 3.5% per win. That's 3.5% per trade. That's all the net gains minus all the net losses. Well, I definitely underperform, even though my account is still slightly above the overall market. So I'm still overall beating the market. But I underperformed myself historically. And the reason I've underperformed myself historically in the first 20 trades of the year is, honestly, I was putting on some shorts, and that cost me. The market just way overshot. This rally went way longer than I thought it was going to go. And I used that based on, history, based on the last, 2015, 2011, 2008, 2001, all these bear markets, they've taken multiple legs down, and so far we haven't taken that second leg down. I don't know if we're going to. But this is what I've actually done. I'm going to drag over, so you can kind of take that for what it's worth. Again, it's okay. My account is still beating the market, but historically I've done a lot better, okay? And so I'm really going to rip on myself. And you might look at myself and think I'm crazy, but I would be anybody who's listening, I would be doing you a disservice by not sharing with you what I have learned and sharing with you how I can get better. Because the truth is, I'm pretty consistent about outperforming the market most years, if not every year. This is just the first 2 months of the year, okay? I'll probably make 75. I could make 75 to 100 trades this year. So I can easily bump this up. So I'm going to talk about exit algorithm number 2. And then I'm going to bring this. So here's exit algorithm number 2. So the discretionary, I try to sell half, raise stop to break even, kind of, and I really do in a mix. This is really a mix of all my exits based on my feelings, which I'm going to show you how that got me in trouble. But it also has to do with, there are some stocks I'll sell way too early because it's about to report earnings, and then it just absolutely took off after earnings. So hindsight, you should have held through earnings, but it could have gone the other way. And then you would have said, well, you should have sold before earnings. So again, we're looking for an average of about 80 to 100 trades to really get a good idea of the differences. And I'm also going to show you how I've, taken what I've learned the first 20 trades and improved. So exit algorithm number 2 is sell half at 8%, raise stop to break even, or if it breaks the 50-day simple moving average, whichever is first. So I'm going to repeat. I'm going to use this 8% throughout all these exit algorithms. You can use 6, you can use 10. The point is to be consistent, okay? So again, exit algorithm number 2, sell half at 8% and raise stop to break even on the remaining shares. Or, so if that second half hits your break even point where you entered, or if it breaks the 50-day moving average, whichever is first, you're out. Now let me drag the performance over. Kind of sucks. Look at the difference. It's night and day, okay? So you have the yellow trades I will still be in. All the green and the reds are close, okay? But look at the average trade. This is net gain. That means every time, if I would have stuck to this, every time I press the buy button, win or lose, I'm making 6.67% in the last 20 trades. Holy crap, that's 6-fold, okay? Now, I'm gonna kind of come back to some of the ones I'd still be in, right? I'd still be in this one, okay? I sold... There were several of these that I sold right before earnings. Roku. I thought the market, I sold at 7.4, not bad. It just continued on a tear. And then it reported earnings and it continued on another tear. Same thing with PAGS, PAGS. And I still own some of this, so I'm happy, right? I still own my core position. But again, I was swing trading around my position. And I sold right before earnings so I could reinvest those back in the core position. And then earnings just went off. So it's just amazing to see how different you can have a completely different system. And really, the only main difference, one of the main differences I made in system from exit 1 from exit 2 is I ignored earnings and I ignored the market. This is the main difference. In here, I use discretion to say, okay, the market's up against resistance. I'm going to go ahead and take some profits, right? In here, I use no discretion whatsoever. And I didn't, and here, I paid attention to earnings. I'm not going to hold through earnings most of the time. Obviously, I should have. But again, it could have gone the other way and you could have said, Steven, you were stupid, right? So, just looking at these, look at what a difference it is, okay? So again, sell half, raise stop to break even. I'd have been smoking this year. And I know, honestly, to be fair, I know a lot of my students, they kind of have their own exit algorithms. All right, so let's look at something slightly different. Let me get a sip of coffee. Love it. Okay, exit algorithm number 3. Sell half at 8%. And use my original stop or the 50-day moving average, whatever comes first. My original stop is going to be under my entry, okay? So if I have an entry at 21.68%, or excuse me, $21.68, let's just say my stop is 6% under that, that's what I'm going to use. Even after I sell half, I'm not raising my stop. I'm using my stop under... And this is a really good strategy that I learned that I'm going to try to stick to. We're going to look at all of these exit algorithms. I'll tell you which one I really am going to try to focus on. So let me kind of bring over to show you a real live example of how this would have been important. Let me kind of drag this over here. Okay. I want to look at Love for a second. Lovesac company. Okay, so I bought here, right? Now, my students did a little bit more than I did. We sold half at like 10%, sold half at break even. I decided to hold on to the whole thing, and I got stopped out at slightly above break even, okay? So instead of, when it hits 8%, I still sell half, but instead of raising my stop, which was way down here to break even, I keep it there. Why would I do that? Okay, I'm going to do that because most strong stocks, they might take out target one, and if you bought it near support, if you bought it near a point where it's easily the market could come back and test, you're protected, right? If the market comes all the way down here, and let's say you had an 8% stop, well then you get out of break even because you sold half at 8%, half at -8, you break even, okay? But my point is, it would have kept me in several trades if I would have kept my stop in my original place after I hit target one instead of raising it. Because look at this, right? I would have sold half at 8%, and the second half I would still be in. So let's kind of look at that for a second. Lovesac, where are you? Right here. So, okay. Sorry, I want to drag the performance of this one, okay? So let's continue, okay? So this is the discretionary where I pay attention to the market and earnings, okay? Try to use a combination of this. Exit 2 is where I'm going to sell half. I'm at 8%, I'm going to raise my stop to break even. Exit 3 is I'm going to sell half, and then at 8%, then I'm going to use my original stop or the 50-day moving average, whichever comes first. So if we go back to the love example, the difference between 2 and 3. Look at the difference. So I would have made, hit my target at 8% and then rose my stop to break even. It would have hit it, right? Selling my second half at 0, netting 4. Versus if I would have kept my original stop in place, I never rose it to break even. My remaining half would still be up. I'd still be in the trade, and I would be up on the whole thing 23%. Okay, so it's half at 8, and then the rest is way above 23, and average out is 23%. It would have kept me in the trade. And then we go back, so we can use the same JD example. JD, I would have hit at 8%, raised my stop to break even, and then I would have been stopped out for a net of 4%. If I would have kept my stop in place, I'd still be in the trade, and I'd be at net 18, almost 19% on the whole thing. You see the difference? Do you see how important that is? So if we look at the difference between exit algorithm 1 and exit algorithm 2, I would be in an additional 3 trades. 1, 2, 3. So the yellow, I'm still in. The green and red are closed. Okay? So I would still be in JD, I would still be in Love, and I would still be in Hyatt. If that's how you say that. It's very, very interesting. Okay, this is one thing I learned that was really, really helpful to me because this happens. Look, in exit algorithm number 2, you're making 4% on a lot of trades because it's coming up, it's hitting your 8%, it's coming right back down, it's hitting your break even, and then you're netting out 4%. Now, I want to be clear. This strategy proved better 6-fold by my discretionary strategy. Exit algorithm number 3 proved better by a lot than exit algorithm number 2, right? By about 25% more. That's significant. And this just goes to show you how the difference between 3 and 2 and 2 and 1 is how important it is to giving stocks room to breathe. Because I think, and I'm going to show you, I think I'm pretty good about picking growth stocks. What I haven't been great at is, at least in the first couple months of the year, is using a little bit of discretion. Because the market just, I think it's gone on way longer. JD, all these positions. So you still own, out of 20 trades, you're still in 5 of them. And all 5 are up more than 15%. Now, the prices are, I got these prices as of the morning of March 14th, pre-market. By the time you watch this, it could be slightly different. But I'm just trying to get you to grasp this concept, okay? Pretty amazing stuff. I hope you're getting as much out of this as I am teaching it, and as I have. And I hope you're not kicking me to my students, saying, well, dang, Steve, like any system would have done better. Well, you're right, but I've still beat the market. But the way I look at it is, again, we're 2.5 months in the year. I can take this information that I've learned and for the rest, 9 months of the year and do pretty well. Do very well. But I think it's also important to notice the market's going to come down and these numbers are going to come down, right? They're going to, this is going to go up and these numbers are going to come in. They're going to get a little bit closer together. But there's still going to be a difference. So let's look at exit algorithm number 4. Exit algorithm number 4 is not for the faint of heart. It's not something that I think I can emotionally do, right? So this is where you just buy a stock and you use your original stop or the 50-day SMA, whichever comes first. So that means you're not selling half, you're not raising your stops, you're not doing anything. You're just buying and basically letting it hit break the 50-day moving average if it works. So your 50-day moving average is going to be your rising trailer, right? Your rising trailing stop, or it's just going to roll over and stop you out. Okay? I personally don't think I can do that because I know what's going to happen in a bad market. It's not going to do very well and you're going to get frustrated. You're probably going to abandon it right before it does something special. So let's look at the numbers of that. Okay? So you would still be in some major winners. Look at this. You'd be in, if you wouldn't have sold half, you'd be in all these stocks. What that means is all 5 of these, right? JD, Love, HUYA, Roku, PAGS, all these stocks never hit your stop and are still above their 50-day moving average. Sounds fantastic, right? Has averaged phenomenal. Just continues to smoke everything. However, there is a downside to this, and I want you to be fully aware. The downside is this. There are going to be a lot of times. I think it's unfair to look at 2.5 months worth of data and say, okay, Steven, you sucked, everything else is better, right? Because there's going to be some really bad markets where I guarantee you my discretionary would have done the best, okay? There are going to be some sideways markets where this one would have done the best or this one would have done the best. These numbers are going to compress the more data we have, okay? And I'm going to show you throughout the year. Every time I get another 20 trades, we're going to update all these numbers. And we're going to look at them together, okay? So you would have some big winners, but look at the losing streak. You have 5 losses in a row. Is 5 losses in a row. So what this means is a couple of these, 2 of these 5 would have hit 8% first. But what that means is 2 of the 5 went up over 8% and then came all the way back down under your break even, all under your entry, all the way back down and stopped you out. So the downside of this is you will go on some major losing streaks. It's going to hurt. Can you sit through it? Because if you can't sit through major losing streaks when some markets that aren't so good, then I think it's important to probably stay away from this one. You have to know thyself. If you can sit through, you might lose 8 out of 10. I mean, right here, how many trades is that? That's 9. You'd have lost 6 out of 10. Right here, you would have lost 6 out of 8. All right? This 44 and this 34 paid for all of these and then some. So again, this is a very, very relaxed. You're going to have some huge winners in this one. Huge, because you're not selling half. You're not selling yourself short. You're just using the 50-day moving average or your original stop to let it ride. But you're going to be in some major challenging markets. This is 2 months worth of data. Let's look at exit algorithm number 5. Sell everything at 8%. Okay? I mean, that means 100%. It's either going to hit your stop or it's going to hit 8%. You're out. Kind of drag this over. 17 of my 20 stocks, that would have been an 85% win ratio, would have hit 8%. But it's amazing. It is truly amazing how, even though, let's look at this for a second, even though 85% would have been winners, and versus exit algorithm number 4, where you would have had 1, 2, 3, how many is that? It's 5, 8. So you had a 60% win ratio versus 85% win ratio. So you have a much, much smaller win ratio. I wouldn't say double, but I'd say 75% more. Let me just kind of do some quick math. Divided by 6, 68% better. You've done 68% better by doing this. Why? Because you have some big winners. You're letting your winners ride. So this is still good. It's still great, right? And again, this isn't going to happen all the time because the market has gone straight up for 2.5 months. We've been in the best rally we've been since towards the end of 2017. So, we're looking at about 18 months. I don't know if we're going to get another rally like this again this year. I don't know what's going to happen this year. So again, you kind of look at any exit algorithm. I am very confident that probably by the end of the year, I'm going to make a prediction. This is going to be above this because this will eventually, have some big winners. I'm going to let them run. And my personal goal, just by looking at this, my goal is to change it to where I'm averaging 5% per trade. Whether that's net gains minus net losses, right? It's just every time you hit the button in 2019. 2.5 months of the year. I feel very confident because I learned this so early in the year that I can achieve that. Because, you think about this, 20 trades. I might make 80 trades this year. I really only need a few of these, and I will probably achieve that. I got a couple ones right now that are just moving, that I really like. I don't know what they're going to do, don't know where they're going to end up, but they could easily, 2 or 3 big ones could easily bump me up right into this category. Because as you can see that, 2, 3 winners in a set of 20, there's a massive difference. So there is a lot you can take away from this. Okay, and I don't really want to sound repetitive. I hope to my students that really are privileged to these trades, I hope, one, you kind of learn from this and say, okay, Steven gave me some great exit algorithms, right? Maybe I take his entries and find the best one for me because it's all about the trade plan, right? It's all about, I don't expect you to perform in line with me. I don't expect you to take every enter and exit trade that I take. I don't want you to. I want you to find something. You can take my entries. I want you to find something that's comfortable for you. Maybe it's this, and that's fine. The important thing is you stick with it, okay? So my personal goal is exit algorithm number 3, right? Because I know I'm not going to do this. And my goal is to really use exit algorithm number 3, try to use that and see how I do, okay? Because I think if I can use exit algorithm number 3, then I easily would have been in some bigger winners by leaving the stops way under the exit, okay? So just kind of want to repeat these. Let's kind of just go back through them because I just really, really want you to get this, okay? We'll just call this E1. All right, this is kind of more discretionary. This is a combination of the 4, except for I added, what the overall market is potentially going to do, and I typically sold before earnings. right? Looks like a bad strategy. Hindsight, it could have gone the other way, and then you could be like, oh, well, right? Using discretionary, and there's going to be times this column, without a doubt, throughout the year, there's going to be 20 trade segments. I'm going to do this that this will be the winner. I have no doubt. Obviously not this one because the market's gone straight up for 9-10 weeks. Okay. Exit algorithm number 2. Sell 8%, raise your stop to break even. You can see how many times that if you would have done that, how many times it comes back. So 1, 2, 3, 4, 5, 6, 7, 8, 9. 55% of the times at 55% of all trades, they're going to come back and stop you out. Okay? So to add that, how many winners do we have? 1, 2, let's see. We also have an 85% win ratio on this one. Okay? And I know some students are using these. Okay, so you definitely did better than me. Okay, but okay, out of the 17 trades, I think I counted 9. Slightly more than half of the 17 winners would have came back and stopped you out at break even. So you walked away with 4%. You could have walked away with more if you would have just given it a little bit more room. So exit algorithm number 3. Sell half at 8%. I'm going to stay consistent with the 8%. Use your original stop. So that means it could hit your target number 1 at 8%. Could come all the way back down to your original stop at -8. That could be a break-even trade. Okay? Or, so you use your stop or the 50-day moving average, whichever is first. So if your stop is under the 50-day moving average, that 50-day is going to catch it. But look at the difference. So you would have had 2 big winners, 3, all pretty much 20% winners out of 20 versus 3, 4% winners. Big difference. Now you have exit algorithm number 4. You just buy. Again, all these are the exact same entry. Okay? And the closing price before the market opened on Thursday. You just buy and then you just let it run. Whatever it's going to do is it's going to do. You're not raising your stop. Your original stop or the 50-day moving average is your stop. Whatever comes first. Okay? With this one, you're going to have some big winners because you're just going to let them run. Right? This by far did the best. I knew it would. But there's going to be 20 block trades where this by far is the loser because you're going to go on some losing streaks because you're not selling half at 8%. It's going to go up 10, 12%. It's going to come all the way back down to -8. So you have to be mentally prepared for that. If you don't think you can handle that, or you think that, when you go on a 70% and you're just losing 70% of the times, you might want to try something else. Okay? And then exit algorithm number 5. Sell all at 8%. Okay? So both of these, you have an 85% win ratio. This, you had an 80% win ratio. And kind of looking at this, 1, 2, 3, 4, 5, 6, 7, 8. So it's 8. So you got a 60% win ratio. Right? And on this one, you have, I think, a 65% win ratio. Look at that. Nope. That's 60. Okay. So 60% win ratio. So you have a 60% win ratio in both, the discretionary and the let it go. But you're up 9-fold versus what you would have. These will come down, right? This number will shrink. This number will shrink. I think these are good places to be at. And, me personally, again, I want you to take this information and do whatever you want with it. But I think this is what I'm going to try to do. Right? I might even, if it hits my 8% price target, and then I have an 8% stop loss, I don't want that to turn into a break even. I might even raise it to a -7 or a -6% stop loss. That way I'm making 1 to 2%, and that way it helps my psychology. But the reason why I like this one, for me personally, is because I know I can buy stocks during support, right? And I know I can buy good stocks, and I think you can see that with this 20 trades. But I know if I'm buying at support and my stop's under it, a lot of times it's going to come back and retest my entry. But it's not going to go all the way down to my stop. It's not going to break my entry. Okay? I hope this was helpful. I pray you get as much out of this as you can. I am looking forward to your feedback. I'm looking forward to your questions. I'm here to help.